US markets are mixed after weak jobs data. Australian GDP shows stronger inflation signals for the RBA. South Korean growth rises. And India's central bank looks unlikely to aggressively defend a falling rupee. That's coming up in our 5 Things in 5 Minutes on Thursday, December the 4th. And then we have the first of 2 deep dive interviews into the outlook for Asian currencies in 2026 with ANZ Head of Asia Research, Khoon.
The Fed easing cycle, the extent of their rate cuts, how much they cut, who's going to be the Fed chair. That's going to be very important. And secondly, how much further does the AI-related investment boom carries on?
But first, in 5 and 5 with ANZ. In data from the US overnight, ADP private sector payrolls fell 32,000 in November. That was well below the market consensus for a small rise. Also, prices paid in services in the ISM index have fallen to a 7-month low. ANZ economist in London, Henry Russell, says the data supports the case for more easing by the Fed.
That move aligns with our view that the recent uptick in supercore inflation is likely to subside, paving the way for a resumption in disinflation in 2026. Alongside our view that tariff pressures on inflation will prove transitory, we remain of the view that it is appropriate for the Fed to continue to cut interest rates to respond to downside labour market risks. We expect a 25 basis point cut at next week's meeting and further easing in 2026, though the FOMC is likely to slow the pace of easing now that its policy rate is approaching neutral.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.3% and the Nasdaq up 0.2%. The US 10-year Treasury yield down 1.8 basis points at 4.07%. West Texas oil futures up 1.2% at $59.34 US a barrel. Gold up 0.6% at $4,244 US an ounce. The US dollar index was down 0.5%. The Aussie dollar rose 0.6% to 65.95 US cents. And the Kiwi was up 0.6% at 57.72 US cents. Number 2, Australia's economy grew 0.4% in the third quarter. That was below market expectations for a 0.7% rise. But as ANZ senior economist Adelaide Timbrell says, there were still some hotspots.
Domestic final demand actually rose 1.2% in the quarter, the highest rate since a similar result in mid-2023. We had slightly stronger household consumption outcomes than expected, with 0.5% growth versus our forecast of 0.4. But the savings rate still did go up by almost half a percentage point, which tells us that people are not necessarily spending a higher share of their income compared to last quarter. We also saw that there was a strong investment pulse that seems to have come from data center investment, adding to all the regular investment that we're doing.
Number 3, Adelaide says strong unit labour cost growth and slow productivity growth would likely have gotten the Reserve Bank of Australia's attention.
Both of these things basically say, hey, our wages are growing faster than actually how much we're doing per hour, which means businesses will likely pass on those costs to consumers, and our productivity growth is not really supporting that changing. So I think the Reserve Bank is likely to be quite cautious about how inflation goes from here as a result of that data.
Number 4, South Korea's third quarter GDP grew slightly faster than initially expected at 1.3%, according to data released yesterday. ANZ economist Crystal Tan says it was the fastest quarterly growth since late 2021.
US tariffs on Korean auto imports are going to be reduced from 1st of November, so that's going to provide some relief to the auto sector as well. So overall, we do expect growth to pick up next year as these factors play out. So from the Bank of Korea's perspective, we have stronger than expected growth, and then combined with sticky housing price expectations and also elevated FX concerns. So those are all pointing to a high hurdle for further monetary easing.
Number 5, India's rupee has depreciated below the psychological barrier of 90 to the US dollar in recent days. ANZ economist Diraj Nim says while the Reserve Bank of India will be moderating the decline, they are unlikely to aggressively defend any certain level.
We believe that this is an acknowledgement that the kind of economic adjustment we need facing the tariff risk, which could jeopardize future growth trajectory and welfare for millions of workers that work in the sectors that will be impacted, weaker rupee should support to some extent, should mitigate that drag to some extent. And I think the Reserve Bank of India is also perhaps thinking along the same lines.
Diraj Nim there. Now, in the first part of a 2-part deep dive interview, ANZ's Head of Asia Research, Khoon explains why ANZ Research has a positive view for Asian currencies in 2026, as the volatility of this year is left behind.
The starting point is the fact that tariffs is well and truly behind us as a major factor in driving FX volatility. Tariff headlines were notoriously a major source of fluctuations for FX markets, particularly in Asia, as the tariff landscape was shifting. But now that we have clarity around that, this is not going to be a factor at all. And in 2026, with the tariff headlines behind us, I think other major drivers are going to be more predominant. And firstly, it's the Fed easing cycle, the extent of their rate cuts, how much they cut, who's going to be the Fed chair. And that's going to be very important in driving not only the broad US dollar, but also the spillover effect on Asian currencies as well. And secondly, how much further does the AI-related investment boom carries on, because that has important implications for Asia's exports and therefore in how Asian currency performance will go. So I think those two, to me, are going to be the primary drivers for Asian currencies in 2026.
So you have this general positive outlook for Asian currencies over the next year. Are there any differentiating factors within the different economies, different currencies, which will point to which might perform better?
When it comes to individual Asian currency performances, this is where the domestic factors or the idiosyncrasies, I believe, will become more apparent. So if you take the AI-related investment boom, for example, we've seen tremendously strong Asian exports throughout the region. But if you look at it, not all economies are benefiting the same. It's largely your technology, export-orientated economies that are doing better. So this is your Taiwan's, your South Korea, Malaysia, and Singapore. So these four have been benefiting more in terms of export performance because their export category is geared more towards electronics. Whereas Philippines, Thailand, Indonesia, and India have not seen as strong of an export kick from that. So that's one important differentiation, and that's been reflected in the currency performances. I mean, that's why the Indian rupee is hitting all-time low, partly also because of the high tariff by the US, but it's also the composition of the exports. Indonesian rupiah struggling, Philippine peso struggling. So that's one important difference. But we also have country-specific factors at play. So for example, the Thai baht has actually been extremely strong despite a sluggish economy. And that's because in Thailand's case, the Thai baht has a very, very strong correlation with gold prices, and gold prices has been doing extremely well, and that's helping to support the Thai baht. So, and that's something that is very, very specific only to the Thai baht, not to any other Asian currencies. In Taiwan, hedging behavior of their life insurance companies has an important impact on the performance of the Taiwan dollar. And for South Korea, the behavior of Korean retail investors is massive in terms of driving volatility in the won. So these are, sort of the more specific local idiosyncrasies that I think will become more important as a driver in 2026.
Khoon go there, who we'll hear from tomorrow on the outlook for the yuan and India's rupee, as well as which currencies might get a bump from monetary and fiscal policy. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, December the 4th. Catch you tomorrow with a look at Australia's latest trade and household spending data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.